Very good morning, friends. So, today, as you can see, we're going to start with a very interesting index, and I think one of the latest index which became applicable from 1st April 2019, and that is Index 116 that deals with leases. Now, you must be wondering, first of all, so how many parts are there going to be in terms of this index? Don't get worried on that. I've tried to segregate the concepts in terms of India's 116 into various parts. So I think I'm not going to disclose at this stage how many parts there are going to be. Now, when I look at the India's 116, the very first thing which comes to my mind is that what are the changes which have taken place compared to the erstwhile standard? We all know that there was Index 17, and this Index 17 was replaced by Index 116. And if you ask me in terms of Index 17, it was quite similar to what you've done in IGAP in terms of AS19. So then why was there a need to bring out a new standard on leases? Why was Index 116 introduced? Now, I would first of all like to draw a little attention to the fact that what are the major changes as compared to Index 17. So whether I say Index 17 or I'm looking at AS19, practically it's going to be one and the same thing. Now, I know you must be wondering, so but I don't know AS19. I don't even remember what I did in AS19. Well, I think even if you remember a very slight information on that, I think it would serve my purpose. Now, let me first of all draw your attention to what was there in terms of Index 17. A very basic input. I'm not taking you to any technicalities. Just want to give you some two very major differences in terms of the old version and the new version of this index. Well, if you ask me in terms of the earlier version, that is Ind AS 17, and if I make a comparison in terms of Ind AS 116, I'm looking at things from the point of view of a lessee, and I'm looking at things from the point of view of a lessor. Well, if you remember, Accounting Standard 19 or Index 17 used to lay down that there is a need for classification of a lease. So whether it was a lessee or whether it was a lessor, we used to classify the lease that it is supposed to be either a finance lease or it is supposed to be an operating lease. So this is how we used to decide. So there were certain parameters which were given in the standard, and with the help of which we used to decide whether a lease is a finance or an operating lease. You know what is the major change in terms of India's 116? They have done away with the concept of lease classification for a lessee. That means if you ask me in terms of India's 116, I would say practically all the leases are supposed to be a finance lease. So you mean to say that there is no concept of operating lease which is left for a lessee? Well, I would not say that there is no concept, because India's 116 has given certain recognition exemptions where there can be an operating lease. But those recognition exemptions are dealing with only two specific situations. One is what you call that it is a short-term lease, and the other is that it is supposed to be a low valued asset. The subject of lease is a low value asset or it is a short term lease. So I can say leaving these two exceptions. So as I said, yes, there are two exceptions. We'll deal with these exceptions in detail later. But I think to give you the exceptions, we can say that there are two exceptions. One is it's a low value asset, and the other is that it is supposed to be a short-term lease. Leaving these two exceptions where we could consider a lease to be an operating lease, they are practically done away with the classification of operating lease, mind you, for a lessee. But as far as a lessor is concerned, the position continues the same. We would be classifying the lease as finance or operating the way we did earlier. So you mean to say the parameters in terms of lease classification is also the same? Yes, they are the same. So, but the main question which is hitting our mind is that why did the International Accounting Standard Board do away with the concept of an operating lease? They have done this away for a lessee, not for a lessor. So what is the objective? What is the logic of doing that? Well, I can only tell you one thing, and I think it's difficult to explain at this end unless you know the parameters of classification of a lease very well, which I think we can discuss later. But let me tell you one thing. If you say that it's a finance lease, the asset and liability appears in the balance sheet. And if it is an operating lease, the asset and liability does not appear in the balance sheet. So what? If in a finance lease it appears in the balance sheet and in operating it doesn't appear, so does the International Accounting Standard Board wanting that the company should reflect the asset liability in the balance sheet? Well, just look at the impacts. If you don't show an asset, you don't show a liability. Now imagine a company is entered into lease contract where the payment of lease is unconditional, irrevocable in nature. So if the tomorrow the company liquidates, imagine there is a huge liability against the company which is not recorded in the balance sheet. And that's what we technically call an off balance sheet items. So, but then the essence of operating lease is that we should not reflect the asset and liability in the balance sheet. Agreed. But what the companies were doing, they were, ensuring that finance lease becomes an operating lease. People were manipulating the accounting world over. Imagine companies like Air India, imagine companies which are in the power sector. Those companies were not having assets in the balance sheet because they had taken all those assets on lease and they ensured that let's convert this into operating lease. Now, I'll not get into the picture. How do you translate a finance lease into operating lease? But trust me, you could manipulate the parameters of classification and you could ensure that a genuine finance lease becomes an operating lease. So if that be the case, where companies would start manipulating, the intention of manipulation is the asset is not there, so liability is not there. And if you have entered into multiple operating leases, running in terms of crores of rupees, imagine the level of understatement of liability, the off balance sheet liabilities in your in your financial statements, which is not as a part of your balance sheet. But if the company liquidates tomorrow, there is a huge liability which is off balance sheet in nature. The International Accounting Standard Board, got an assessment of the fact that the industry at large, I would rather say the world over at large, companies were manipulating the concept of classification of leaves. So, but then why not a lesser? Trust me, a lesser cannot do that kind of manipulations which a lessee can do. The scope of manipulations in terms of classifying a finance into operating lease was only open to the lessee. So the International Standard Board, just did one simple little thing. They said from today onwards, you will consider all lease to be finance, which means you're going to show the asset in the balance sheet and you're going to show the liability also in the balance sheet. So understatement of liability is one area which is taken care. And I think let's also make another mention. When you calculate, for example, so as I said, if you look at the basic logic in terms of doing this, then I can say that was a twofold logic. One logic I gave you. The first logic which I gave you in terms of this is that it was leading to understatement of liabilities. It was leading to understatement of liability. And another very interesting thing is it was doing a very good picture to the ratio analysis. Sir, ratio analysis? Where does the concept of ratio analysis come in terms of lease? Imagine when you are calculating a fixed asset turnover ratio, how do you calculate a fixed asset turnover ratio? So sales divided by fixed assets? Great. So when you consider the sales divided by the fixed assets, now imagine the chain of thought. Sales is something which is not within the control of the company. It is dependent upon external market factor. So I cannot do anything about the sales. It is the demand situation outside in the market which decides the sales of my company. But imagine if I reduce the fixed assets of my company, can I say this would increase the turnover ratio? And that would consequently send a signal to the stakeholders of the company that the sales generated per rupee of investments is good. That's right, sir. So imagine if the company enters into, leases for assets which are operating in nature. The asset doesn't appear in the balance sheet. And I think I'm getting more incentivized by considering these leases to be operating, because if the asset doesn't appear in the balance sheet, I get a goody goody turnover ratios as well. So the industry at large, what they were doing, that when they were entering into leases, they were ensuring that let's manipulate the terms and conditions of the lease in such a way that it becomes an operating lease. At one hand, it improves my fixed asset turnover ratio, sends a signal to the investor that the amount of sales generated per rupee of fixed assets is great. And on the other hand, by not recording the asset, since we apply a double entry bookkeeping, there is no liability as well, and it was leading to non-recording understatement of liabilities in the books of accounts. And I think one complete hammer in terms of things, took everything at rest. So all the international standard board had to do that from today onwards, there is nothing called an operating lease. So the fixed asset turnover ratio manipulation, gone. Understatement of liabilities, gone. This is one of the major changes which has come. Invariably we hear that the major change in terms of 116 is that all leases are financed. No, it's only from a lessee's point of view. The concept of lease classification for a lessor continues to be the same as the earlier version, that is Ind AS 17. Now, this is one major area. Then I would say there are a couple of other major areas also, but at this stage, I'll give you another second major area of introduction. If you look at the Ind AS 17, there was not much guidance on, identifying that if a particular contract is entered between two parties, whether it's a lease or not. Ind AS 116 has given a huge stress on the fact how to identify that a given arrangement, how to identify that a given arrangement is a lease. They've got a very scientific way of deciding that a given arrangement is a lease. Because earlier versions of standard only gave you a definition, that this is a lease, but there were not a broader guidelines given in terms of deciding, when an arrangement or when a contract between two parties would give rise to a lease. India's 116 has introduced a detailed three-step procedure. Sir, again three? Sir, I think you're certainly fond of three. No, I'm not. Trust me, this time this three-step procedure is actually given in the application guidance in terms of India's 116. So it is not something which I have created. It is already there in the appendix itself. So they've given a three-step procedure in terms of identifying that a given arrangement is supposed to be a lease. So I would say, yes, there are other changes also, but I guess if somebody were to very apparently ask me at the forefront that what is the major distinction, so I would say one is doing away with the concept of operating lease for a lessee. And the second is giving a detailed three-step procedure in terms of identifying when an arrangement is supposed to be a lease. Now, as we begin the topic, and I think you're already aware that whenever I begin with a particular topic, I always first of all look at the nomenclature of the standard. And this time, the standard is called with a very cute little name called leases. And when you look at the term called leases, I think the first thing we need to do is we need to consider what is the definition of a lease. Okay, so what I'm going to do, I'm going to come back to the text of the standard. And I am first going to read the definition of lease, and the definition of the lease is given in the Appendix A. So I think I need to first take you to the Appendix A. So I'm taking a little jump and directly taking you to the Appendix A, where we are given the definitions. And I think let's have a look at the definition of a lease. Here is the definition of the word lease in Appendix A, and I think let me read the definition carefully. It says a contract or a part of a contract. Now, I think let me tell you something. It is not necessary that when you enter into a contract, the entire contract may be a lease. It is also a possibility that the contract has got, a lease and a non-lease component. So can you give an example? Let's say, for example, two parties enter into a contract where one party allows the other party to use a car. And along with the car, he also gives him a use of a driver. Now, when you're going to provide services, services would never be a case of a lease. For a lease, there has to be an asset. So when you enter into the contract, which is comprising of, let's say, a service agreement along with an asset, it would give rise to a lease and a non-lease component. In fact, that's another area where the Ind AS 116 gives us a lot of elaborative details. How do you identify the lease and the non-lease components of a contract? We're going to come to that later. So we will be coming to that in detail as a separate section, that if a contract has got lease and non-lease components, how do we segregate what is the portion which relates to lease and non-lease? So I think for the time being, let's forget about the word part of the contract. So for the time being, what I'm going to do, whenever I'm going to read the standard, I will say a contract. If it says part of the contract, I know that he's looking at lease and non-lease components, but to avoid any complications, I think we're going to ignore it for some time. It says a contract that conveys the right to use an asset for a period of time in exchange for a consideration. Now, let me first of all also, put some terminology at the back of your mind. I think let me just create an image, because as we're going to proceed with the standard, we need to get a little more clarity with the terminology as well. Imagine there is a company A Limited and imagine there is a company B Limited. If you look at the definition of lease, I would say the first important element of the definition is that there is a contract. Needless to mention that the contract is always between two parties. And let me tell you that under this contract, A Limited is called a supplier. I'm not saying a lessor. And B Limited is being called as a customer. I'm not calling it as a lessee. Ind AS 116 is such a beautiful standard that it says that when you are looking at a contract, at the very inception, you should always assume that the contract is between a supplier and a customer. Let's say A Limited gives B Limited the right to use an asset. I would say that A is a supplier and B is a customer. Once you meet the parameters of a lease, once you zero down on the fact that yes, this contract is a lease, once you zero down on the fact that yes, this contract is a lease, which you are going to decide with a three-step procedure. With the help of a three-step procedure, you will decide it's a lease. Once you establish it is a lease, I'll call the supplier as a lessor. And once you decide that it is a lease, the customer is going to be called a lessee. So isn't that funny? No. Because unless you establish that the contract is a lease, you cannot come under the purview of 116. Then you're more under the purview of 115. So even if you remember, if you read Ind AS 115, in 115 also, revenue is always a case of a contract. If you look at the nomenclature of 115, it says revenue arising from contract with customer. So every time there is a contract, trust me, there can be multiple situations. Financial instruments is a contract between two parties. A revenue is a contract between two parties. A lease is a contract between two parties. So it is very important the contract entered between the two parties is in the nature of lease or not. So every time you read a question, you would see that the question would also use a language supplier and a customer. So once we fulfill the three-step criteria and we say that yes, this contract is a lease, then we'll say supplier is now going to be called as a lessor and the customer is going to be called as a lessee, because if it is not a lease, possibly it could be covered under 115. And if it is a case of revenue, then it is certainly a case of a supplier and customer. Makes sense, sir? Now, as I said, this is one aspect that there is a contract. So this is one, that there has to be a contract between A and B. That's one. Second, the contract is for what? The contract would mean that A Limited gives B Limited what we technically call an ROU asset. That's called a right of use. Because in this case, A Limited is not giving a legal ownership to B. So B as a customer, if he becomes a lessee later, is going to show this asset in the balance sheet as an ROU. So there has to be a ROU asset, what we technically call in the Ind AS as an identified asset. Is technically called an identified asset. So there has to be an identified asset. And naturally, when A gives the right to use an asset to B under a contract, there has to be a tenure for the contract. It's called a lease term. And once there is a contract for a certain tenure called a lease term, it also has to be for a certain consideration. And that consideration is what we call a lease payment. That means when I am looking at a definition of lease, I would put it like this, that there are four critical terms which are used in the definition of lease. Is there a contract between the two parties, apparently a supplier and customer? Once it becomes a lease, he's called a lessor and a lessee, which allows B the right to use an asset for an agreed period of time. That's called a lease term for an agreed consideration, which is called the lease payments. I would be dealing with the concept of ROU asset, identified asset, in detail later. I would be discussing the concept of lease payments in detail later, because I would discuss these point number 2 and 4 appropriately under certain appropriate sections. I don't think so I need to discuss the word contract. Contract means it's a legal binding contract between the two people, the two parties. So my focus right now is on the lease term. I could have done the discussion of a lease term at a later stage, but I think I want to do it right away. So when we're going to understand the concept of lease, the focus should tell you in the mind that there are two parties, supplier being called as lessor later, the customer called a lessee later, provided a three-step criteria is met. The contract will convey B Limited the right to use an asset for an agreed time, lease term, for an agreed payment. That is called the lease payment. So what constitutes a lease payments later? How do you look at an identified asset later? The focus is on the lease term. Now, if you come back on the definition once again, it very clearly says a contract, focus one, that conveys the right to use an asset, underlying asset, identified asset, ROU asset for a period of time, lease term, in exchange for a consideration. And trust me, if you're able to zero down the concept, you don't need to remember the definition. You can simply say that there are four focus points: a contract whereby one party allows the other party to use the asset for an agreed time for an agreed consideration. I may not be saying verbatim the same words, but the essence should fall in place. So now my focus is on the lease term. So I thought today in part number 1, I'm going to focus on the concept of a lease term. Now, for a lease term, I need to take you back on the standard, and I guess I need to take you to para number 18. So I'm going to take you to the para number 18, where we're going to discuss the concept of a lease term. Now, hear me very carefully, because there are certain portions which we're going to read in para number 18, which might be a little disturbing to the mind, but once we're taken some examples, you will become absolutely clear on the agenda. Para number 18 says an entity shall determine the lease term as a non-cancelable period of a lease. The question rises, what is a non-cancelable period? Well, you can say the period during which a contract cannot be terminated by either of the parties. It is a period, which has to be honored under any circumstances. The period in which the lessee, that is, you can say the customer, is required to make the lease payments unconditionally irrevocable. That is a non-cancelable period, and that would always be given in the question. It says together with A and B. Now, when it says A and B, in terms of A, it says the periods covered by an option to extend the lease. The periods covered by an option to extend the lease if the lease lessee is reasonably certain to exercise that option. It's a little technical. Can you put this in a little simpler words? You can say that every contract may have a renewable option. Let's say A and B enter into an agreement for a period of 5 years, but then they have renewable options. So let's say we have given the lessee that if you want to extend the lease, you can do that. So I will consider the renewable option, the period of renewal, as a part of the lease term. It says if it is certain that he will exercise the option. The question arises, how would I determine that the lessee will exercise the option to extend? Then it says in B, don't worry, we're going to come back to that. Then it says in B, the periods covered by an option to terminate the lease if the lessee is reasonably certain not to exercise. So this is literally confusing. I would put it like this in a mathematical manner, that when you look at a lease term, I would say lease term is a sum total of 1, 2, 3. Now, what is 1? Non-cancelable period. And what is 2? Option to extend. And what is 3? Option to terminate. Just remember the three key terms. The lease term is a non-cancelable period plus option to extend plus option to terminate. Now we need to work upon the concept of what is that option to extend and what is that option to terminate. So let's do one thing. Let's first of all work upon option to extend, and then let's work upon the option to terminate. It'll take a little time, and then I will illustrate all this with practical illustrations with you. And I'm going to take the study material today for the purpose of elaboration of these concepts. And trust me, there are questions in the study material concentrating only on the aspect of the computation of a lease term. Now, let's focus only on the para number 18A. We'll deal with para number 18B later. It says we need to add the periods covered by an option to extend the lease if the lessee is reasonably certain to exercise the option. A Limited entered into an agreement with B, a contract with B, and told him there is a non-cancelable period of 5 years. He also gives B Limited an option to renew, extend the lease. Now the question rises, if it is extended, let's say by another 5 years, do I take the lease term as 10, 5 plus 5, or do I take it only 5, which is non-cancelable in nature? Para number 19 elaborates the concept of para number 18A. The para number 19 is not talking of 18B, it is talking in terms of 18A. And see what it says in para number 19. In assessing whether a lessee is reasonably certain to exercise an option to extend, and then it says, or not, I'm leaving that. It says it should create economic incentive for the lessee. So hear me very carefully. When you are looking at the para number 18A, and we are evaluating that, do we consider the extension, the renewal period, as a part of the lease term, you need to ask yourself a question. Do you think that there is an economic incentive for the lessee to extend? If yes, consider the renewal period. If no, then don't consider the renewal period. So can you take an example? Okay, let's, I think, right away take you to the study material where I'm going to take you to an example understanding this in a little more detail. So I'm going to first of all take a little jump in the study material on, yes, here we are exactly on the illustration I wanted. So let's have a look at the illustration number 16. Don't worry, the notes will come later. First, I think I need to connect you on the concept. It says entity ABC enters into a lease for equipment that includes a non-cancelable term of 6 years. Remember, the lease term is a non-cancelable period plus option to extend. Let's not consider the third factor right now. So we say ABC enters into a lease that includes a non-cancelable term of 6 years. So undoubtedly 6 years is definitely the lease term. And it says a 2-year fixed price renewable option with the future lease payments that are intended to approximate the market rates at the lease inception. Imagine my landlord telling me that you can renew the lease for another 2 years, but I'm going to charge you the market rates. What do you think my reaction is going to be? I'll say that if you're going to charge me market rates, then I can take it on lease from anybody else. Why you? You are not giving me any favors. If you're going to charge me the same rental what prevails in the market, I don't feel that I have any economic incentive that I would extend the lease. So para number 19 is saying what? You would consider the renewal period as a part of the lease term if you feel that the lessee has got some economic incentive. If somebody is going to charge me a market rates for the renewal period, I don't see that I am incentivized. Then he adds on further, there are no termination penalties or other factors indicating that ABC is reasonably certain to exercise the renewal option. He says, I don't see any factors which is indicating the certainty that he will exercise. So there is no reasonable certainty. The lease term is supposed to be 6 years. So illustration 16a is indicating a situation where the reasonable certainty is lacking. Why is it lacking? Because I don't see economic incentive. Why I don't see economic incentive? Because he is charging me the market rates itself. Let's have a look at the scenario number B. He says entity XYZ enters into a lease for a building that includes a non-cancelable term of 8 years and a 2-year market-priced renewal option. Even in this case, the rentals being charged for the renewal period is supposed to be based on market rates. Before it takes the possession of the building, entity XYZ pays for leasehold improvements. Leasehold improvements is that the structural changes might have been done by the lessee in order to make it ready for its own use. So he might have done some leasehold improvements and which are capital in nature. So during the before he took the possession of the building, he did a lot of leasehold improvements expenditure. The leasehold improvements are expected to have a significant value at the end of 8 years. Your non-cancelable period is 8 years, and by the end of 8 years, he says the leasehold improvements will have a significant value, and that value can only be realized. Because if you leave the building after a period of 8 years, then all those leasehold improvements is simply scrapped to you. He says it can be realized through continued occupancy. Is that giving me an economic incentive to extend? Yes. If I want to get the benefits out of the leasehold improvements which I have done on the building, then I think I am incentivized to extend. So there is a reasonable certainty that the lessee will extend the lease, and in this case, the lease term is going to be considered a period of 10 years. So the illustration number 16, A and B, and trust me what I'm going to do, but I'm going to make notes with you. I think I'm going to link up the illustration number also so that you can correlate exactly the thought process. So, moral of the story, we have understood that a lease term is a non-cancelable period, always given in the question, and it includes the option to extend, but is included only when there is a reasonable certainty that lessee will extend, and for which purpose you need to evaluate, is there an economic incentive to the lessee to extend or not. Like in scenario A, there was no economic incentive, but in scenario number B, we could see the economic incentive. So the renewal period, that is the option to extend period, is going to be added to the lease term only when the lessee has got a reasonable certainty of extension. I think that's pretty simple, makes good sense. Now, I'm not taking the scenario number C. So why? That is a little special case. And I think we need to deal this a little later, though I think even if I take it at this stage, you'll understand, but I don't want to mix up the concept. So out of this illustration, we're done with scene A and B, not C. Now I think I need to do some technical discussion with you. Don't worry, we will certainly pen down the notes to you. But before that, I need to take you to a little more technical discussion on para number 18B. The explanation to para number 18B is given in B34 and B35, Appendix B of Index 116. So, how do you, with such an ease, quote the para numbers with such an ease? I'm very fond of para numbers. And when you get fond of certain things, you will, not make much conscious effort to remember them. Because when you put a conscious effort on learning, learning is always slow and never passionate. If you're passionate about a subject, trust me, learning is going to be fun. So even if you don't remember the para numbers, it's okay. But I just remembered them, so I thought I'll tell you that the explanation to 18B is covered in the para number B34 and B35. What does it say in 18B? It says periods covered by an option to terminate. The periods covered by an option to terminate the lease if the lessee is certain, reasonably certain, not to exercise the option. I know, frankly speaking, you would say, sir, I didn't understand. The option to terminate, and it is certain that the lessee will not exercise the option. So, example, no, not at this stage. I'm going to first take you to the Appendix B, read the para number B34, 35, related to the illustrations with you, and then you would understand it very well. So let me come to the para number B34 and let me come to the para number B35. Here it is. Lease term, para number 18, cross-referencing. It says in para number B34, in determining the lease term and assessing the length of the non-cancelable period, an entity shall apply the definition of the contract and determine the period for which it is enforceable. To calculate a lease term, it is important to identify the period during which the contract is enforceable. Lease term is equal to the period when the contract is enforceable. And I'll look at the beauty in terms of para number B34. First, he says that you need to determine the period the contract is enforceable. So, how do I decide for what period a contract is enforceable? He gives you a negative definition. A lease is no longer enforceable. First, he's saying, what is a lease term? The period it is enforceable. So, my mind is telling me, what is enforceable period? He says, no, 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 no. A lease is no longer enforceable when the lessee and the lessor each have a right to terminate the lease without permission from the other party and with no more than insignificant penalty. So, this is getting dangerous. We need an example. How can one understand this technical language? I know. I'm just reading it. I'll go to the practical illustration. I'll come back to the language. Because if you feel that you should only do a question and get the concept, I call that as a gorilla counting. Keep practicing questions and you get a concept based on those questions only. If you do the right kind of questions, you get the right kind of concept. If you do limited questions, you get some limited concept. So I always believe you should read the text of the Indias. Let me read para number B35, then I'll take you to an example and I'll come back. Promise. It says in B35, if only a lessee has a right to terminate a lease, that right is considered to be an option to terminate the lease available to the lessee that an entity considers in determining the lease. If only a lessor has a right to terminate, the non-cancelable period includes the period covered by the option. Sir, went off. All said and done, even if you don't understand para number 330, B34 and B35, I'm sure you'll appreciate one thing. Look at the start of the para number B35. Only a lessee has a right to terminate. One. The last sentence, if only a lessor has the right to terminate. Two. Para number B34, second last line, lessee and lessor each have a right to terminate. So termination rights are with both. So it is very important that when you calculate a lease term and you look at the option to terminate, you need to see who has got the option. If both have an option, B34 gives me a guidance. I'm yet to know what is the guidance. If lessee has an option, I go to para number B35. And if the lessor has got an option, I go to B35. So para number 18A is elaborated by para number B34, 18B, sorry. The para number 18B is elaborated by B34 and B35. So, example. We'll surely come back to this para numbers, but I think first you need to share an example with us. Okay, there is a wonderful example, not an illustration, but there is a wonderful example given in the study material. And with that example, trust me, you'll be able to understand the concept of B34 and B35 beautifully well in the next 10 minutes. And then I'll document all this to you. Suppose the term of the contract is 10 years and the non-cancelable lock-in period is 6 years. Lease term is the non-cancelable period 6 plus the option to extend. This illustration is not on the option to extend. This is on the option to terminate. And can you see in terms of this example that there are a total of 3 cases with me? And trust me, One person would look at these examples and create a concept. And I think I showed you the paranumbers. I'm looking at the example. I'm going to go back to the paranumbers and then I'm going to document the notes to you. Cement it. Look at the first column. It says termination option is with the lessor. So B35. Very good. Second column, termination option is with the lessee. So B35. And the termination option is with both. So B34. Super. At least you've come to know that which paranumber to locate in terms of which permutation combination. Now, when it says if the termination option is the lessor, let me read this, then I'll go back to the paranumber. It says if the termination option is with the lessor, the lease term is 10 years, 6 years non-cancelable, and 4 years is the option to terminate, which we are including 6 plus 4. Let me put it again. Your non-cancelable period is 6. After 6 years, lessor has the option to cancel. Lessee does not have an option to cancel. The lessee's obligations to pay would continue even after a period of 6 years until the lessor terminates. And why would a lessor terminate if he's getting money? It says the lease term is 10 years. He gives you the reason because even after 6 years, the lessee is contractually bound until the 10th year because the contract is for 10 years. So when A and B entered in a contract, A told B, 6 years non-cancelable, neither I can cancel nor you can cancel. After that, I get an option to cancel, not you. So we're going to continue for 10 years, but after 6 years, I can cancel. So the lessee is contractually bound until 10th year. That is, lessee cannot refuse to make the payment till the expiry of the contract and has the right to use it until 10th year unless the lessor terminates. And I think if you go back to the para number B35, look at the last portion of B35. If only a lessor has the right to terminate, the non-cancelable period includes the period covered by the option to terminate. What is the period covered by the option to terminate? 4 years. 6 years is the non-cancelable period. He says the non-cancelable period will include the periods covered by the option to terminate. So, if the option to cancel is with the lessor, in that particular case, we will include that 6 plus 4, that makes it 10. Let's have a look at the other situation if the termination option is with the lessee. So then it should be 6, but we're looking at the answer 10. I would say it can be 6 or 10 depending upon the facts of the case. See what it says, the lease is 10 years assuming a reasonable certainty. So there has to be a reasonable certainty that the lessee will not terminate. So that means if there is a reasonable certainty that he will terminate, then it should be 6. Exactly. And he gives you a reason because after the expiry of 6 years, though the lessee is not contractually bound, the lessee can refuse to make payments anytime without the lessor's permission, but it is assumed that lessee is reasonably certain that he will not exercise the option to terminate. He's got the rights, but we are taking an assumption he will not exercise the right to terminate. Hence, there is no enforceable obligation from lessee's point of view beyond 6 years, but based on the assumption, we're taking it to be 10. So that means if the lessee has got the option, the lease term could be a period of 10 or the lease term could be a period of 6 years, depends upon whether he will terminate or not. So, para number B35, we want to look at the first line. If only a lessee has the right to terminate, that right is considered to be an option to terminate the lease available to the lessee that entity considers. So you need to consider, will he exercise the option? No, include the 4 years. Yes, exclude the 4 years. Answer: in a situation if both the parties have got a right to terminate, 6 years. It can be 10 also. See what it says. Because after sixth year, either party can terminate the contract without the consent of the other party, and hence the contract is not enforceable after 6 years only. In case there is insignificant penalty. So didn't get that. I'm going to take you back on the text on B34 and understand this. A lease is no longer enforceable. I need to consider the period when it is enforceable. It says it is not enforceable. Number one, lessee lesser each, that means both, have the right to terminate without permission from the other party. And so where is the and? It's not there. I'm saying and with no more than insignificant penalty. If you say that both the parties have the right to terminate, you need to see, can it be terminated without significant penalty or not? Let's say if anybody can cancel the contract, anybody can terminate the contract by paying a heavy penalty. Why would I terminate if I have to pay heavy penalty? I will terminate only if I don't have to pay a heavy penalty. So which means if both the parties have the right to terminate, you need to focus on, is the penalty significant or insignificant? If it is significant, at the 4 years, because we will not exercise the option to terminate. And if there is insignificant penalty, leave that 4 years. Because after 6 years, anybody could cancel. There is no penalty for cancellation. So it's a free world. So, moral of the story, I think now I need to, first of all, get things very clear at the back of the mind. So, I think let me first of all zero down on the concept and then give you some notes. My mind is now working on the concept that when you say a lease term, my mind tells me that a lease term is a sum total of non-cancelable period, always given in the question, plus option to extend that depends upon the reasonable certainty. Will the lessee extend? He will if there is economic incentive. He will not if there is no economic incentive. And accordingly, you add or you don't add. And the third is the period when you can terminate. Like after 6 years, you can terminate the lease. It depends upon who's got the right to terminate. If the right to termination is with the lesser, include that for always. If the right to terminate is with the lessee, depends. If you feel that he will terminate, don't take it. If you feel he will not terminate, take that for. And if both the parties have got an option to terminate the lease, look for the penalty is significant or insignificant. If it is insignificant, don't add for. And if it is significant, add the for. So we have now also linked up on the concept of option to extend illustration 16 AB and the example for the option to terminate. I think it's the right time to document everything along with the mapping of these examples and illustration to make life jingalala. So let's do one thing. I am now going to put a note, on the concept of a lease term. So as I said, there are four key aspects in the definition of lease. We've understood contract. Lease payments is what we're going to understand later. And lease term is the main focus right now. So we said there is a lease payment later. We said a ROU asset later. Contract we've understood. The focus was only on a lease term. So we said a lease term is a sum total of non-cancelable period. It is a sum total of a non-cancelable period plus option to extend. It is a case of option to extend plus it is a case of option to terminate. Option to terminate. Now, what do you need to see in each of these factors? Let's, I think, zero down on that. When you say it's a non-cancelable period, it'll be given in the question. Don't worry, it is always given in the question. So I don't need to identify a non-cancelable period. That's always given in the question. We saw the illustration 16. We saw the example. It is given in the question. So we are safe. When you say option to extend, my reference, of course, if I want to give you is in terms of para number 18a and which is explained in terms of para number 19. That is only if you want to make a reference later. In terms of option to extend, what do you need to see? You need to basically see, will lessee extend? We need to see that will the lessee extend? Is it reasonably certain? Is it reasonably certain that he will extend? So you need to basically evaluate, will he extend? Do you feel that it is reasonably certain that he will extend? So I would say it all depends upon whether economic incentive to the lessee is present or not. We need to see whether the economic incentive is present to the lessee or not. So when you're looking at the period that you can renew, you can extend, should I include that extended period? All depends upon whether the lessee has got an economic incentive to extend. Now, in this particular case, we can say the economic incentive is present. Yes. The economic incentive is not present. No. If the economic incentive is present, we will include the renewal period. And if it is not present, we will exclude the renewal period. As simple as that. And if I rightly remember, I think let me link up the illustration number 16 and scenario number A was dealing with this. And the illustration number 16, scenario number B was dealing with this. So when you go to revise the para number 18A, read with para number 19, you would simply look at these two illustrations and you will know, okay, when to include and when not to include. Now, if I come back on the concept option to terminate, then I would say the option to terminate is covered by the para number 18b, and the para number 18b is elaborated in terms of the appendix para number B34 and in terms of B35. Well, you don't need the para numbers. This is only if you want to make a walkthrough later in terms of the chain of sequence, what is to be read in order to understand the concept. That's going to be quite of ease of reference to you. Now, when you look at the concept of option to terminate, then we said there are going to be practically three cases in this. There are going to be practically three cases in this. The first case is that the option to terminate. The option to terminate. So I think we can put it like this. Option to terminate is something which is common for all three. So we're going to look at the option to terminate. We said the option to terminate is with the lessee. The option to terminate is with the lessor. And the option to terminate is with both. Now, once you zero down in the question that the option to terminate is with whom, then you can easily decide the fate. If the option to terminate is with the lessee, you need to see, is it reasonably certain? You need to see that is it reasonably certain that he will terminate? Is it reasonably certain that he will terminate? So you need to only evaluate that do you think it is reasonably certain that he will terminate? The answer is yes, I am certain he will terminate, or I am saying no, I don't think so he'll terminate. So if you say yes, it is reasonably certain that he would terminate, then I would say you will not add that 4. I think in keeping that example as a base to make it more clear, I'll take 6, not the 4, because I know he will terminate after 6 years. And if you say no, then in that particular case, I'll add that 4 and the lease term will become 10. So you just need to see the certainty whether he will terminate or not. If the option to terminate is with a lesser, we will simply include that 4. We will take 6 plus 4 because he would not terminate. He has got the option to terminate, but why would he refuse? He's getting money, so he would not terminate in that situation. And in a situation where we say that the termination is with both, the option is with both, we need to see the amount of penalty involved. Is the penalty significant? Is the penalty significant, or is the penalty not significant in nature? If the penalty is significant, that means they will not exercise. And if they will not exercise, I will not include that 4. I'm sorry. If it is significant, then they will not terminate. I'll add that 4. Because if it is significant, they don't want to pay a penalty, so they will continue. And if it is not significant in nature, then I will not include 4 because they are not bothered. They know that even if they cancel, what's the big deal? You don't need to pay any penalties, at least significant amounts. So this is the entire permutation combination which would decide a lease term. But this is not the end of the story. There is something more which we need to discuss before we close the journey on the concept of a lease term. The para number 18 and the para number 19, along with the para number B34 and B35, is telling you how to determine the lease term at the commencement when you enter into a contract. Now the question arises that can there be a reassessment of a lease term? Is there a possibility that we might have to reassess a lease term? And I think the logical mind would tell us, of course, yes. Maybe the certainty which is present at the inception goes off. You are certain that you will extend, but later you feel, no, I will not extend. Maybe there is no certainty that you would extend, but later you said, okay, I'll extend. And that's not a very difficult task. I think looking at the facts of the case itself, you can easily decide whether a change in the lease term would take place subsequently or not. And I am going to directly take you to the concept of illustration number 17 and illustration number 18, which will demonstrate me the concept when a reassessment is done, whether I will change the lease term or not. You just need to apply a simple little of logic. So you need to see that the certainty which was present is gone, or the certainty which was not present has come, and accordingly I could include or exclude what I had taken earlier or I had not taken earlier. Let's, I think, go to the illustration number 16 and illustration 17. So you remember, oh no, it's not 1718. I'm afraid, I think this time, oh, 1718, correct. I remember the illustration by chance. You love the illustration numbers also? No. In illustration number 17, I am given retailer M enters into a 5-year lease for a building, followed by 2 successive 5-year renewal, option to extend. So I can say a 5-year lease is supposed to be the non-cancelable period and the 2 successive renewable option. I mean, it depends whether the option to extend is reasonably certain or not. It says on the commencement date, the retailer M is not certain, reasonably certain to exercise the extension. So we took the lease term to be 5. At the end of third year, the retailer M extended to include another floor from the year four due to business acquisition. So you might have acquired a control over another company. So your business is expanding. So you need more space. And for which purpose we took another floor. For this purpose, the lessee concludes a separate 7-year lease for an additional floor in the building already leased. Now you've already taken an additional floor in the same building. So what do you think the fate of the existing lease is? Possibility that you're going to extend. So the reasonable certainty which was missing at the inception is now present at the end of third year. So there is a need to reassess the lease term. But the basic input is that if the lease term undergoes a change, what kind of accounting do we apply? That is not the agenda right now. That is something which we're going to learn when we come to the accounting in the books of lessor and lessee. But right now, we can certainly say that the change in the circumstances is resulting in the fact that a reassessment should take place. Let's, I think, take you to another illustration 18, which you can again simply apply your logics. Company N has taken 10 vehicles on lease for an initial period of 5 years, with an extension at the option of the lessee for a further period of 5 years at the same rental. So initial 5 years is non-cancelable and the extension would be taken if it is reasonably certain. The remaining useful life of the vehicle at the commencement date is 15. So the total life of the asset left over is 15, though we entered into the contract only for 5 years. Company N has determined at the commencement that it is reasonably certain to exercise the option of extension and they took the lease as 10 years. So we were certain at the inception that we will extend. So we took the lease 5 plus 5, 10. It says at the end of fourth year, there is an announcement by the government that all the cars in this particular model have to be discontinued from the road within 1 year due to the change in the pollution norms. I think it goes without saying that if the government makes an announcement, I would not extend the lease. I will not extend the lease. So in this particular case, will their lease term be reassessed? Undoubtedly, yes. You can notice that in illustration 17, it was a change in terms of your own business decisions. And in terms of illustration 18, it's more like a forceful decision on the company that you got to make changes. So we have understood the large concept in terms of lease term. And the picture is that lease term is evaluated at commencement. And then there can be a need for a reassessment depending upon the change in the facts. That extension which was not taken is taken later, or it was taken and now you feel it should not be extended. So lease term is done, the definition of lease is done, but before I close with the part number one with you, I think it's now also time to tell you, how this index has been totally divided. I'm also going to divide my index discussion into various parts. Oh, so we got the picture that you're going to divide this index into how many parts. What you're going to tell us is almost the parts in which you're going to divide the standard. Yes, sort of. Possibly could be a little deviation. The first concept is understanding what is a lease, which we have done today. And a related concept is how to identify that a contract or an arrangement is a lease. Where I said we need to understand a 3-step procedure. So we've understood today what is a lease, but then there is a 3-step procedure with which we will appreciate when do you say that a contract or arrangement is a lease or maybe contains a lease. Then we need to understand how do we segregate the lease and the non-lease components. Because as I said earlier, that you may enter into a contract comprising of the lease and the non-lease components. So how do you identify that there are various components in a lease? How do you segregate those lease and non-lease components? That's another area of discussion. Then we need to consider the accounting, and the accounting is to be seen with reference to the books of the lessee. The accounting is to be seen from the point of view of the books of the lessor. So how does the accounting takes place in the books of lessee and in the books of lessor? And then we're going to deal with some special issues with you. And the special issues what we're going to deal with is, like for example, we're going to discuss the concept of a sale and lease back. You have a little bare idea that what is a sale and a lease back transaction. You sell the asset and the other party leases the asset back to you. We need to discuss another area in terms of a manufacturer dealer lessor. So what is that? A company engages in outright sale and also engages in leasing the same assets. Like one point of time, Bajaj leasing company, they were selling scooters outrightly for cash, and they were also giving the assets on lease. Then there is another issue which deals with the concept of a sublease. If you lease the asset further to someone, then how do you account for a sublease? And then we also need to deal with the concept of a transitional provisions. When a company entity would have applied this Ind AS for the first time, that means a switch over from the earlier version of Ind AS 17 to Ind AS 116. In that particular case, how would you apply the concept of a transitional provision? So I would say the entire Ind AS 116 stands organized in almost four different parts. So we've only understood one aspect in terms of what is a lease, where the main focus has been on a lease term. So the further sections would be in terms of a three-step criteria: segregating the lease and non-lease components, accounting in the books of both the parties, and the special agendas in terms of the four issue. Once you're able to zero down on all these concepts, then you can say, yes, we're going to hang in terms of Ind AS 116. That's all for the day for the part number one. We're going to see you back again. Till then, thank you, take care, and goodbye.